The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm your host, Brian Akers, president and founder of Akers Financial Group. Our show is called Winning in Retirement, and our co-host today is Jeff Akers, vice president of Akers Financial, certified financial planner practitioner, and all-around good cousin. Jeff Akers, good morning.
Good morning, and all those things that Brian just said apply to him too.
Still waiting on the Christmas present, but you're a good cousin still?
It could be a long wait.
Yeah, that's okay. All right, so we got a lot of work to do today. Jeff and I have been working on a show to try to explain taxes and why do we want to pay tax now and not later, and then try to explain it to people to make them want to say, that's a great idea.
Well, yeah, and you actually came up with a word to describe it.
It's called Levelize. So today you're going to learn about the word Levelize, and the show is called Pay Less Tax, Levelize. We are saying pay less tax over a lifetime, not just the tax season. Now, when you work with accountants or whoever, you only worry about, am I getting a refund?
Right.
Am I getting my money back, right, Jeff?
What about this year? That's all you care about.
And it's not even about what income I made, what the deductions were. It's like, what's the bottom line? Did I owe or did I get a refund?
Right. Do I get a refund?
That truly has nothing to do with planning, what your bottom line is.
Right. If your plan is, I'm going to pay as little as I can this year, then most likely you're going to pay more later.
Correct. So the more deductions you take in the current tax year, whatever year it is, you're basically postponing to your future self and saying, hey, older Jeffrey, pay that tax for me. I'm not paying it today.
That's right.
Now, you could argue the CPA concept would be, well, if you take net present value of the current cash flows and you take, the money and you project the interest rates, then that's cheaper dollar in the future. So I should not pay tax now, pay tax later.
Right. Because of inflation, the dollar's going to be worth less. But if it's worth less, you're going to need more of them in order to maintain your lifestyle. So you're still going to pay tax on kind of the same amount of money.
It's amazing to see successful savers that want to retire paying more tax in retirement than they did during their lifetime of work.
Yeah, we see it a lot.
Even in an environment where the current tax law is actually lower on the brackets, but people are paying more tax now because of what they did years and years and years ago that affect today's taxes.
Yeah, so, there's a lot of different directions we could go right now, but I guess one would be with the tax brackets and how they work. Yeah,
we got to have an understanding of taxes, how the U.S. federal income taxes work, so then people can listen to the show and say, oh, I get the idea, but then I better call Akers Financial about how to make this work in my exact situation.
Right, because we talk about the financial fingerprint. Everybody's situation is unique. What works for your friend or your neighbor or your uncle or your brother or sister probably won't work for you because you've got different income. You've got different circumstances. All
right, Jeff, when I ask you about steps, what is the the highest amount of steps you've ever seen or walked up, or what picture's in your mind when I say, hey, that's a lot of steps?
Wow, there was a place in Nassau in the Bahamas, the Queen Staircase.
Okay.
That was a lot of steps.
Yeah.
Well, I walked up.
My roommate in college, he was the hokey bird at Virginia Tech.
Oh, yeah.
To get in shape, he had run the stadium steps.
Oh, my.
I went with him once.
Did you run the steps with him?
I stopped. Long story short, the hokey bird loses about 12 pounds on those old 1980s suits. Right. They're incredible shape, the mascots are, and they have to be to survive a football Saturday.
Just to carry the suit around.
Yeah, but those steps intimidated me. I do enjoy the Philadelphia steps where you go up top like you're Rocky.
Oh, like Rocky?
Everybody loves to do that, and that's doable. It's better than some other ones. But imagine this. The United States federal tax brackets are steps.
Oh, yeah.
They're steps. So basically, if you're on the ground and you want to pay zero tax, wonderful. You basically need to make how much money, Jeff, to pay zero tax?
Well, zero tax depends on the standard deduction. How much can you deduct?
Oh, yeah.
So whatever you earn, as long as you can take a deduction to offset that, you won't pay any tax.
All right, so standard deduction is higher since 2018 because the Tax Cut and Jobs Act, that made the standard bring in like deductions and everything all in one package. And so a single standard deduction is $15,000 for 2025, and for married filing jointly, it's $30,000. So that's sort of the floor of where we don't pay tax.
Right.
But once you get $1 above, you go to that first step. What's the percentage federal tax rate on that first step?
10%. 10% on the first step.
All right. So when we explain things to you, there's going to be income and then taxable income.
Right.
Taxable income is a number that we need to know. So if you look at your tax return, you look at AGI, just a gross income, but you got to look a little further down under taxable income. That's where you hit your brackets. That tells you what step you're on.
That's right.
So first step's 10%, and once you make money there, and so basically the first, let's say they're married filing jointly on an example, the first 30, you're at the floor, and then you make $30,000 $1, you step up and pay 10 cents on that next dollar.
Right.
And then you make from basically from zero officially taxable income to what level to before you step again.
So for married filing jointly, it's $23,850 this year.
All right. And then once you get $1 above that, it jumps to the next bracket, which is amazing. How much more instead of 10?
It's just 2% more. It only goes to 12%. So we're not talking about a giant step.
Yeah.
We're talking about a baby step.
All right. So if you're walking up steps, you probably stub your toe because it was a change of change. It's a little change.
You stumble because you don't even realize there was a step
It won't hurt your knee.
No, it won't.
But you will stub and trip.
Yes.
And the trip would be you might owe because you jumped the bracket. Yeah. So the funny thing is that when you have a husband and wife and they're working and they're making money and they're withholding like they're in a 10% or a 12% bracket, as soon as they file and put them together, they might jump to this next step. That next step bracket is the monster step.
Right. You go from 12 to 22%.
But that's only after a married filing jointly makes how much money, Jeff?
$96,950.
All right, so married filing jointly, taxable income of $96,950. The next dollar, you're on that next step. You're paying 22%. That's 10% more money.
That's a big jump to get to that one.
And this is a common reason people owe money when it comes to their tax season. Is that if they have multiple jobs, they're not withholding enough anywhere.
Right.
Or the husband and wife combine their income, they both did deductions, they combine it, instead of being at a 12% rate, they're at 22 for some of their money, net effective rate of 15, 18, nerdy stuff like that.
Yeah, just think of it this way. You fill out that W-4 for work and they ask you, are you married? Yes. And then you don't fill anything else out. They're going to assume that whatever you make at that job is your only income. So if you and your spouse have the same income, really it's twice as much. And so it can be really easy to jump that tax bracket without realizing it and then owe money at tax time.
Yeah, so that next step, 22. The thing about the 22%, so for single, that's half of the married filing jointly, which makes it about $48,475. About half?
Yeah, that's it.
Roughly half. Yeah.
That is close. Well, it's at least close to half. I'm not going to do the math in my head right now.
Yeah, we've stopped you from doing that.
Yeah.
But generally, so understand that with us so far is that we were walking up some steps. So the federal taxes are steps. 10%, 12. We're visiting the 22 step.
Right.
Now, 22 step, if we get above a number, what's that next number?
$206,700. All
right, so a lot of money.
Big jump, yeah.
That bracket's all at 22%.
Yep.
And then when you get 206,700 married filing jointly, the next dollar is at the next bracket jumps to?
It's another teeny tiny jump. It goes to 24%.
I don't mean to be rude and say not as noticeable because it's 2%.
But it's not.
It's only 2% on the money above, so you don't see the effect too much. Mm-hmm. But it is more federal tax. And the problem really is some other things start to lose your deduction on them.
Yeah, there's more than just hitting the tax brackets at some points. And
yeah, that's an add-on. And we'll get to that steps with the step plus concept.
Right.
But it's the idea, we're 22, 24. In my brain, the 22, 24 is close to the same.
Right.
And so when we talk about levelizing and maximizing brackets and maximizing the step that you're standing on, we're going to talk about what is that bracket? So if the 22 is at 206, where does the 24% take us?
That goes up to $394,600.
All right, and that's taxable income of $394,600. That means if you add the standard deduction above that,
another 30.
Another 30. So we're sitting at $424,600. That's the number to be below to be in that 22, 24 level of the steps.
Right. As we go.
All right, then let's talk about the next steps. The next steps, you're at 24, and you really have to bend down and jump to get to the next step.
Yeah, it's 32%.
32% on the large number.
Yeah.
So you're talking 8% more on every dollar above. Actually, as you're wandering through the brackets of 200 to 424, what happens is that they throw in things like investment tax. They take away deductions. They take away some of your energy credits. They limit, once you get to this 32% bracket, they're going to take away things like your business deduction and other pieces. That's the 32% bracket. And all right, this quarter's coming quick. We haven't jumped all our steps yet. What's after 32?
32 goes to 35.
And that begins at the $501,000 bracket to $751,000.
Yep.
And then we hit 37%, which is the max.
That's our highest.
Official federal rate currently.
Right. That's the income tax rate.
All right. So our show today is called Pay Less Tax, Levelize. You need to understand that the taxes are built on steps. As you go up the steps, you pay more money in federal. And what happens is this. Well, should you pay more? Should you pay more now? Should you pay more later? What are we going to do? I know it's definitely a big topic for our show is about levelizing how you pay and when you pay.
Right. And do you know what the tax rate will be when you're retired, 10 years down the road, 20 years down the road?
You do?
I don't. I was asking if you do.
I don't.
You don't either.
Yeah.
So nobody knows.
We can make assumptions.
Yeah, we can make assumptions.
Yeah. All right. Well, at Akers Financial Group, we love to deal with what's real and what's reality and what are the laws, what are the rules, so we can live with it, work within that, and then plan to the future in a worst-case scenario basis. That's how we try to do it. Akers Financial Group, we're local, we're independent. We don't report to a big company on Wall Street, a big company in Iowa. We report to you. We do have offices in Lutherville, Forest Hill here in Maryland. We also have satellite ways to meet with people around the Mid-Atlantic region. And, of course, there's a magical virtual concepts of meeting people, which we do around the country and some around the world. It's so easy to begin winning in retirement. Just give us a call and schedule your free meeting with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. And we'll give you a call on Monday to schedule a free in-person meeting. Why pay taxes now? We will explain when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement, the radio podcast put on by Akers Financial Group. I'm Brian Akers, president and founder of Akers Financial Group. My cousin Jeff Akers, vice president of Akers. We're both certified financial planner practitioners, financial advisors from Akers Financial Group. Here on the radio show today, and we have one of our favorite topics, which is about levelizing taxes over a lifetime, and we call the show Pay Less Tax, Levelize.
There we go.
That's the way to monetize, I heard.
Oh, yeah. Oh, keep going.
That'll energize your retirement.
Oh, energize.
It'll open your eyes to the taxes that you pay.
That's right.
And that's no surprise.
And that way you can retire wise. Oh, I took your word.
Were you supposed not to take my word? All right. Well, close enough. Thankfully, Jeff didn't wrap it or do spoken word with that. We sort of played with it nicely and fairly.
Yeah, we were gentle.
All right. So the idea is this. If you missed the first quarter, you missed our steps of taxation on the federal level. It's a riveting, incredible talk there.
Oh, yeah. Taxes are always thrilling. People love talking about that.
So Jeff's steps were the amazing ones in Bahamas, of course.
Yes, those were cool. Now, when you talk about the most steps ever, I've never been to like Central America where they've got those Aztec
Mayan
things. No. Yeah, I've never gotten to see those, but those are huge, I understand.
Yeah. And Brian was talking about what kind of steps? I forgot already.
Stadium.
Yeah.
You ran with the hokey bird.
Yeah.
At least through one section.
I didn't go all the way up there. The worst thing in Virginia Tech was doing the steps in the actual basketball stadium. They're at a pitch that's almost like straight up.
Yeah.
That was insane.
Yeah, that's hard.
All right, moving right along. I'm Brian Akers. I'm certified financial planner. I'm president of Akers Financial Group. But I've been doing tax returns since I was 12 years old. Yes, my father did taxes.
Yep.
My mother would hand type them in her basement of the house.
Yep.
And there's a year when I was 12, I was paying attention to things, and he goes, here, do your grandmother's. And so I figured it out. Oh, that's easy. I can do this all the time. He goes, then he gave me a hard one, of course.
Yeah.
But back then, everything was by hand. And then my mother would hand type the tax returns.
Yeah.
So that there wouldn't be any mistakes.
It's almost like once computers came along and became commonplace, Congress was like, oh, we can complicate this more now.
Yeah. Well, if they're in session, they're working on that.
They're complicating it.
Well, the hardest part is this. In financial planning, you have to understand tax law, and then you have to apply it to you, the individual, and your exact situation. Pay less tax over a lifetime is our talk today by a concept of levelizing. We want you to think about paying tax now and get it over with and making that be a priority in how you build your wealth.
Okay. So pay tax now so that later on we're not paying as much. That's
the idea.
What you're trying to do. Yeah.
One great example was we talked about the 22 and 24% bracket. That goes from 96,000 up to 206 on the taxable income, and then it jumps all the way to 394 for 24%.
Right.
That bracket might be the best bracket you'll ever see for those that do very well income-wise.
Ooh,
and it's painful to say, hey, let's pay some more tax at a 24% bracket and for everybody to be okay with it.
Right.
Because it's real money.
Yeah.
That goes, and it goes to the federal government. You pay now. Now, what we're talking about is decisions like 401k. Do I put money in my Roth IRA at 401k and pay tax now, or pre-tax it? If I pre-tax it, it lowers my income. I get a bigger refund. It feels nice and happy. And today I'm happy with it.
Right.
And so today, that's a wonderful thing. And most people that do their return, they look at that bottom line. They're like, oh, I won. I got a refund.
Right.
I lost. We don't want to look at it that way.
Right.
We don't want. How do we want to look at it, Jeff?
Well, we want to look at it like I paid the right amount this year so that in the future I won't pay more than I have to.
So proper planning would try to hit your number of a little bit of refund. Mm-hmm. We're not happy to give them a big refund because we want the money every day that we can have it.
Right. Now, they're not going to pay you interest on the money that they refund you.
We don't want to owe where we end up with a penalty for owing too much. So you got to watch that.
Yep.
So taxes are not just a beginning of the year thing. It's hey, let's look at it again later in the year and do a tax projection.
And let's plan all year to see what we can do to levelize our taxes.
As our clients are growing their wealth over time, and we're talking people that have been extremely successful, you must look at the taxes. Now, does that mean you have to do it? No, financial advisor.
Why we're here.
Financial advisor would be great. Let them do the tax estimates. Let them figure out where you stand and how to maximize a bracket so you can squeeze money in.
Mm-hmm. Yeah, there's a lot to figure out, but I got a little ahead of ourselves, but I asked before the break, do you know what taxes are going to be in the future? And the answer is we don't. We don't know for sure. We don't
know, and sometimes you feel like there's lots of debt, there's lots of issues, there's the issues of Medicare and what it really truly costs over a lifetime. How do you fix Social Security without more money?
Right.
More money seems to be a good answer when it comes to fixing things, but that's a hard answer too. No one wants to do that.
Yeah.
You probably win votes by saying, I'm going to give you more refund, but...
Right. Brian made the point before that the 24% bracket was kind of a nice place to be because it's not that much above 22. But if tax brackets went back to what they were before current law, then the 22% bracket would be 25%, which is already higher than the 24 that we have now.
But the 24 bracket was 28 and it was 33.
Yeah.
And so as you're paying 24% bracket, there's a certain spot of income where if we would retro back, which is what the law says, if we retro back in 26 and go back to the 17 law, what would happen? I'm sorry, this is very nerdy. What would happen is you drop back to that old percentage would have been 33% for some people under 400,000 of income, and that's big difference of 24. That's a 9% difference.
Right.
And so the idea is this. You try to plan out your tax rate today. So one of the things is most people don't even know what their tax rate is today.
Right.
And then so they all focus on refund versus owing and the effects of that. We want you to know what tax brackets you're in, your effective rate, and then we want to take your planning to the future. And if you're saving and doing a very good job of saving, are you going to be in a low bracket in retirement or higher? We're under the assumption our clients want to keep the same lifestyle. They want a lifestyle. They want more freedom. They want that money to work for them and take care of them. So that means that money is going to make money. That means you're going to pay tax on that money someday.
Right. Inflation is a real thing. We all know that now. And so when we're retired, things will cost more. So you're going to need more dollars in order to buy the same stuff that you need now.
Yeah, so some of the proposals in Congress when it comes to the federal tax law and way to do things is to try to limit Roth contributions for people that make too much money.
Right.
And there are some laws already in there.
Yeah, there's a cap to your income.
Yeah, that they can put Roth in, right?
Right.
Yeah.
Directly.
Yeah, so you have to watch all of this. And then it comes down to things called Roth conversions, where maybe they take away your ability to do a Roth 401k because you made too much money. Mm-hmm. And then you have to do Roth conversions on other money.
Right.
And then the pain of that is you have to have cash to pay it.
You have to pay the tax now on the amount that you're converting.
Yeah, so this topic, when it comes to levelizing, is the pain of writing an estimate check, of paying the tax more right now. And with a Roth IRA, you pay tax now, never again.
Right. You said before that when you try to minimize your taxes now and you're just going to pay it all later, you're telling your future self, go ahead and pay this. That's your problem. Well, when you do the conversion like Brian's talking about, your future self is going to look back to your current self and say, thank you for doing that.
Yeah, they will, because if you look at a Roth IRA account, guess whose money that is?
A Roth IRA? That's my money.
That's your, well, it would be the client's money, Jeff.
Okay.
I'm sorry, we're talking about
my
that.
Roth IRA is my money.
Yeah, think about it that way. That's a good way to think about it. So the idea of a Roth IRA, all of it's yours. When it's an IRA or 401k, 403b, TSP, any of those versions, that's partially federal, partially state, depending on where you live.
I've got a partner.
That partner's going to take their chunk before you even get your chunk.
That's right. And sooner or later, that partner's going to say, you got to take money because you're going to pay me.
That's the RMD, required minimum distribution, which is a welcome to your 70s, 73, and up to 75 if you're born in the 1960s. That's when you have to take money out.
Right.
And when you take money out then, if you've saved really well and you have multiple millions in retirement and all pre-taxed, all of a sudden you're taking out 80, 125, 250.
Right.
I had one the other day. It was like 208,000 we got to take out.
That was the RMD?
That's the RMD. And the problem is that I said, let's take that out and convert on top of it. Can you believe me?
Well, you're trying to use the current tax brackets, which give us an advantage in the long term.
I was trying to explain other problems. The problem is if you are successful, there's more tax to come.
Right.
There's things like in the state of Maryland, if you pass away with more than $5 million, there's an estate tax, I think 16%, that comes out of more money above $500,000.
Right.
How do you freeze your savings, freeze your growth? You're doing really wealthy investments, and all of a sudden you've bumped way up above that number. I'm like, hey, we need to spend some money.
Right.
And that's what was my presentation. We need to do estate freezing and spend some money, pay some tax, converting. It goes to the kids down the road.
Yeah, we don't like telling people you've got too much money. So,
well, it's good when the kids are sitting there in the meeting too going, yeah, all right. Now, when do we get this money?
Yeah.
Yeah. It's a good and bad thing because the client's like, it's my money.
Right.
And when I'm done, you'll get the money.
We're going to use this for the client.
Oh, the other taxes in the future. There's something called IRMA. IRMA, we don't even have time to cover it in this quarter, but the idea is that means testing for Medicare is already in effect. Yep. If you make more than like $218,000 in 2025, you could pay Medicare premium of up to double over time, depending on what you make.
Sometimes 1.5 to 3.5 times
of what you're paying for Medicare for you and your spouse, just because you made too much money. If your plan's going to hit that number, you might want to do a different plan right now.
Right. In fact, you might want to go ahead and do it now a lot and then don't do it again.
Oh, man, because we're talking about taxes. We're talking about the idea that you will pay tax on this money someday. We're trying to do planning, and we love doing the planning. Do you enjoy this, Jeff, when you fix things for people?
Well, I like fixing things for people, yes. And I like it when they understand.
But you can't fix future tax at zero by not paying tax now. So paying tax now becomes part of this plan. That's what we do at Akers Financial Group. What we invite you to do is to call us for a free meeting to talk about your exact situation, your fingerprint, your unique fingerprint. And we talk about how to apply that to your ability to win in your retirement by keeping the most money for you as possible. Now, at Akers Financial Group, we want to help you with that, and we offer this free time. So go ahead and call us at 833-WIN-RETIRE. Schedule a free in-person meeting with one of our team of advisors. That's 833-WINRETIRE. That's 833-946-7384. Or visit our website at akersfinancialgroup.com. Scroll down to the bottom of the homepage and schedule a meeting right there. How do you control your tax rate? We'll explain when we return. All right, we're at Winning in Retirement third quarter. Brian Akers, Jeff Akers. The show today is called Pay Less Tax, Levelize.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Here with me today is Jeff Akers. We're both from Akers Financial Group. You can see the trend of Akers and all that.
Yes.
It was real hard to figure out what to call the company.
Right.
I went with Akers Financial Group.
Right. It was kind of started as a family.
Yeah.
Well, we're still family.
We are, but the company has grown incredibly well. I've been very blessed with the company and all the clients and people we get to work with. It's been a great 19 years of Akers Financial Group. And
yeah, amen to that.
I think 1987, was that 38 years this year for me.
Wow.
But that's been starting in financial services and then growing into an advisor. And
right.
And I know you've been with me since September of 2000.
Yeah.
And that's 20.
It's coming up on 25 years.
I owe you a present for that?
I think so.
Oh, yeah. Okay.
I'll have to think about what that should be, but
yeah. All right. That sounds great. I'm still unwrapping my present you gave me at 25 years. All right. Sorry for those listening, but we're cousins, and sometimes we joke and we go off the rail. Sometimes.
Yeah, we get off topic.
Our jokes aren't that funny, but you're still listening, which I'm very thankful for. You're hoping for some good advice. Our show today is called Pay Less Tax, Levelized. If you missed any of this talk, I believe you need to listen to that first quarter to understand tax brackets, and then you got to listen to that second quarter about how we begin to apply it. And then here in the third quarter, we're going to bring it home when it comes to how we do it, how we levelize tax now, pay tax now, so that you have the ability to control your taxes now in the future. Having control is what we want our clients to understand is a great thing. So the question this quarter is, how do you control your tax rate?
Well, one thing is when you are contributing to your 401k, TSP, whatever, on a pre-tax basis, you are not paying tax now, you're deferring that to a future point in time. And when you do that, you're giving up control of how much that tax rate is going to be, because we don't know what it's going to be in the future.
Right.
On the other hand, if you contribute to the Roth portion of your 401k or TSP, you're controlling the tax rate that you pay on that money, because that's money that it went in after tax and you never pay tax again. So nobody else gets to tell you how much to pay in tax on that money because it's not taxable in the future.
Yeah, so for those that listen to the show over the long term, you know I like the idea of cash cows. Cows where we take little calves, and we grow them up, and we have separate buckets of money. My favorite buckets of money are ones that are tax-free. Roth IRA is a big deal. Roth 401k, the idea of Roth, where you pay tax now, let it grow tax-free, is a big deal. And we try to apply that everywhere we can while you're working or even in retirement. Try to make that work. Life insurance cash value can be another way to grow your money tax-free if we can help you at a younger age to use that in the right way. It's not always the best thing as we get older because we got to still qualify for a life insurance policy to make it work. But It could be another tax-free way. And then the third thing is more tax advantage investing. And that would be personal investments. That might be treasury bill where you don't pay the local tax. It might be other ideas that allow for deferral.
Right. And even just in tax, I guess tax advantaged, I'd call it, is with those non-qualified accounts that are paying dividends or you've got capital gains. The capital gains rate and the qualified dividends tax rate is generally 15%.
Right.
Whereas your income tax would be 22% or higher. So that is a tax advantaged way of having money set aside, even though you're paying it every year.
Yeah, so CDs, you pay ordinary income tax rates.
Yep.
A dividend off of a stock, if it's qualified dividend, you pay less tax.
Right.
Just in the way it's given, based on the current laws.
Right, on current laws. And if your income, if you're in the 12% bracket roughly, then the capital gains rate's actually zero.
The ability to control taxation, can you make that more obvious or help people understand why that's so important? It's a big deal, controlling the taxes.
Yeah. Boy, how do you make that obvious or stand out?
I guess the hard part, like, so say someone's 73, 75 years old, they come in, we look at the end of the year's last at the 1231 value of your IRAs, 401ks, 403bs, and then we calculate a number that you must take out, need to or not.
Right, whether you need the money or not.
And then there's only one way to avoid taxes on that, right, Jeff?
Well, yeah, if you give to charity.
Yeah, so out the RMD, required minimum distribution, we tell some people if you don't want to pay tax, the only way is qualified charitable distributions, and we teach people about that all the time.
Right, so for folks that are giving to charities anyway, it's kind of a no-brainer. Give that money from your IRA instead of out of your checking account, because the money in your checking account you already paid tax on. The money in your IRA you didn't pay tax on, and now you can give it to charity, and nobody pays tax on that money ever.
Yeah, so let's go to this idea of controlling tax, and what do we got to do right now? And so one way of paying the tax now is by going through your 401k at work and changing from pre-tax to Roth.
Okay.
And that will change your bring-home pay.
Yes, it will. Your take-home pay, your net pay will be less because now you're paying tax on the money before it goes into that Roth 401k.
In the future, this year, maybe this year, and definitely in 2026, the law changes to where there's going to be a way to make your employer match Roth also, which logistically is going to be a bit of a nightmare to make it happen, where you have to pay the tax on what the employer puts in.
Right.
That's going to hit your payment, your net pay. Your net's going to go down if you choose to do that. But it could be a very wise thing to do in planning once we get all the logistics down per 401k provider.
Yeah, they've got a lot of things to navigate through to get there. That's for sure.
Now, you might have a job that you're blessed with that you get a pension in the future. Now, that pension, it gives you money. It's going to turn on a certain time, and that's going to be taxable. You're going to have your Social Security, and if you make enough money in certain areas, you're going to make your Social Security is going to be taxable.
Right.
And then you add in this RMD at 73, 75, and that makes all the savings you build taxable. And then if you have investments, or if later in life you want to sell rental properties, I met with a lady this last week where she wanted to downsize and move in with her kids. She's 83 years old.
Okay.
Want to sell her home, sell her rental properties. And the hard part was working out all the options.
Right.
Her home, we could avoid the gain.
Right. There's an exclusion.
Her husband had passed away, so we talked about step up in basis on the rental properties and went through that. We went through the idea of researching cost basis and what she's going to really owe, and for her to make her life more simple, there's a lot of tax decisions involved in the planning.
Right. Now you always look at the end result. Okay, I'm going to walk away with this much money, but it's kind of similar to your paycheck. There's a net amount. You don't get that gross amount, that top line amount.
Yeah, and so what happens is that the idea is no matter what you do or how you save, if you don't pay tax now, a lot of times with our rental properties and things, they grow and you take deductions and you basically use all the cost basis.
Yeah, you depreciate it.
You appreciate it, and then you're thinking about, hey, I want to sell it, and then someone says, oh, here's your tax bill, and you just gulp.
Yes.
And then you got to consider things like 1031, exchanges, stuff like that. Mm-hmm. So the idea is controlling your taxes. You need to understand what you have, how you invest your money to control it later. Fundamentally, it goes like this. In America, if you're listening to our talk right now, you must first of all consider saving to a Roth.
Okay.
Roth on your own, Roth through work. If you can do that now and save as much as you can, you are going to benefit long-term in a very good way tax-wise.
Right, because it will be tax-free income that won't then affect other things that we've talked about, like your Medicare premium or how much Social Security is subject to tax. It's just totally tax-free.
Yeah, I mean, some people do financial planning. They'll even map out the future. And the problem is there's assumptions to all of that. And the crazy thing, it's real simple. What's your tax rate now? Do you want to be at the same income level? If rates don't change, it'd be the same. Or if you didn't save much money at all, you will be lower. So it doesn't make sense there. I like the idea of tax-free and locking that money in, taking the hit now where you're working, living off less now so you can pay your tax.
It helps in another way. If it's okay, I wanted to jump to what happens when you're married filing jointly, but then one of you passes away.
Yeah.
And then the survivor, we talked earlier in the tax brackets that the individual thresholds for each step is about half of what it is for married filing jointly. So when one spouse passes away, one of the surprises that comes is that the survivor's taxes go up at that point because they actually go up a bracket sometimes. If you've got similar income, you're probably going to be in a higher bracket at that point. So levelizing our taxes also has to do with protecting your spouse down the road.
It really happens under the RMD because normally what happens with the retirement accounts is the spouses say, I love you, and all the money goes to each other. Then the RMD is calculated upon the survivor. Mm-hmm. And then what happens is they take this withdrawal, and that withdrawal is about the same as it was.
Right.
And you're staying in the same bracket. The thing about converting, if you convert to a Roth, there is no RMD where you have to take your money out.
Right.
If you pass away, the kids get to keep it tax-free for 10 years before they have to take it out.
Yep.
So the Roth becomes a great way to give legacy, to give money down the road. Also means, oh yeah, I paid tax back in 1998 when it first came out on that.
Right.
I haven't paid a dime of tax since that day.
Right, and you won't. So it's a way to that spouse, that surviving spouse, could take money out of that if they need it. You know, they don't have to take it out, but if they need it, they can take it out, and it's not taxable. It's not going to affect their brackets.
Yeah. So how do you control your tax rate? Some of this has to do with good fundamental financial planning and on what you can afford. And then what we want to say is something like this. You cannot afford not to consider this. Mm-hmm. To consider levelizing, paying some tax now. The healthier your salary is, or the wealthier, the higher. Understand that if you do some very important decisions now, pay more tax now, you're going to be better off when you want to retire.
Right.
Better off in that your money becomes your money. You're not sharing it.
Right. And we're not saying maximize your tax now. We're just saying we pay some more now, but we're working with those brackets to do the wise thing.
Absolutely. Because we all know in retirement, the best part is going to be getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement, where you do the things that you want to do, like not pay taxes. Go to our website at akersfinancialgroup.com. Scroll down to schedule a meeting section. Let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Yes, you do pay taxes in retirement. The question is, how little will you pay? We'll explain when we return with more of Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement. I'm Brian Akers, and today I have with me Jeff Akers. We're both certified financial planner, practitioner, financial advisors with Akers Financial Group. And we're hosting this show, Winning in Retirement, right?
That's right.
Now, Winning in Retirement sounds like a great name for a radio show. The hard part is paying taxes. You don't feel like you're winning when you're paying tax, right?
No, paying as little tax as possible is how you win. It's like getting as few penalties as possible in football.
All right. Today's show is called Pay Less Tax, Levelize.
There we go.
Now, it happens to rhyme with exercise.
Yeah, yes.
Which reminds me of sports.
Okay.
If I want to win that game,
Yeah.
I need to exercise now to be in shape so that I can outcompete. I can use my speed. I can take advantage of the opportunity to win the game.
This was the older Brian, or the younger Brian, I should say.
Yeah. Older Brian ain't getting in faster. So if we go back and we look at everyone's financial planning, we can go back and say, oh, I should have done this. The thing is this. Let's look at today. Today, how can you benefit your future self? No matter what age you have or you are right now, what can we do better? That's financial planning. We look at where you are now, where your savings is, and we say, well, what can we do to make things better in the long run? The pains of more taxes, the means testing where successful clients end up having to pay tax on Medicare.
Yeah.
And
Extra.
It's called the IRMA tax. And how do we avoid that? There's also major decisions when it comes to just the idea they get upset with I'm retired, I paid tax my whole life, and now I got to pay tax in retirement. All these concepts are going to be on our website with this recording under the Winning in Retirement tab under radio podcasts, which is our website, akersfinancialgroup.com. You can listen to the show anytime you want through that or on any podcast network out there.
Yeah, I've been surprised at how many times I've been asked, at what age do I no longer pay tax?
Yeah, you think 90, 95, 100, 105, there'll be a number, right?
And there is no number. And the look on their face when I tell them you never stop paying tax.
Yeah, what's the joke is about what's things that are sure?
Two sure things in life.
Yeah.
Death and taxes.
Yeah. Death and taxes. The taxes don't have to lead to the death.
No.
We believe that controlling the tax and working it through is the wise thing. This quarter, we're talking about, yes, you do pay taxes in retirement.
Yes, you do.
And you do pay taxes on Social Security based on the current law.
Right. Depending on your income, there's thresholds to it.
I can't wait to redo the show and say that, I'm redoing the show because you no longer pay tax on Social Security.
That would be nice. I mean, a long time ago, that was the case.
It was.
Yeah, but it changed.
Way back in the day.
Yeah, well, back in the 90s, we got under the current threshold.
Yeah, that's when they bumped it up again. I think Reagan was the first one to tax it.
He taxed 50% of it, and now it's up to 85.
And 20 years later, and then we're sitting 25 years later 30 years later from the last time.
It would be great if it went back to zero.
Great. Yeah,
Well,
we're not going to discuss that too much, but we're all talking about taxes in retirement. You do pay tax in retirement based on however you saved your money. It's almost like whatever you did, the work you did, the ramifications of the future. If you pre-tax everything so you get more refunds and get that refund in your pocket today, you're going to pay later.
Yep.
Like I had a discussion with one of my clients who's been with me 35 or 34 years.
Okay.
We had an accountant involved, and the accountant said, "Oh, you want more refund now?" And I'm saying, "No, you don't. You want to have this Roth.
You want to convert.
You want to convert now. We want to contribute to a Roth." And so he had him contribute to an IRA on the last day, take a deduction, and then the guy was like 69, and back then it was 70 and a half. The next year, we were pulling it right back out.
Right, and paying tax on it.
And every time they asked for the withdrawal, I said, we didn't have to do this. If you listen to the idea of long-term thinking, put your head up. Don't just look at your tax return as a refund. I can make you have a refund every year. Mm-hmm. Put more in.
Right.
You just take more out of your pay.
If you pay too much in taxes, you'll get a refund.
Right. And is that winning? No, not in my mind. That just means you got the right outcome because you dumped a lot of money in your taxes. Sorry, I get a little frustrated with that if you can't tell. So the idea is what's affecting your taxes? What's going on there? We need to see the return so we can look at it and say, all right, let's do this. Mm-hmm. You'll pay more tax today. We're going to squeeze your bracket. So we're going to levelize. We're going to squeeze what brackets you're in. Take more out, Roth convert all the way up to the top of that bracket. And then if we mess up, you go over that next dollar is at the next bracket, not all of it.
It's just $1.
Yeah. And then we're going to convert it. And then guess what? It grows tax-free.
Right. Tax-free. Later on, you take it out. Doesn't matter what the tax brackets are.
And then we invest the Roth to grow. That's how we invest that money. Let that money grow.
Right.
Let it make money.
That's the last money that we want to use.
Yeah, unless we have a situation where I had this case the other day, probably 3 months ago now. Life flies by. The client called in and said, I need money. And I go, all right. So I said, no, you're near that limit, that Medicare. If you go over it, you're going to pay higher Medicare. And I said, I can get you up to bump ahead on the level, but we're going to have to take some money out of your Roth. But because I had the Roth, I had a choice.
Right. So that's exactly what you're talking about, having options, having choices, being in control.
That is what we want for each and every client so that we can win in retirement. Winning isn't just having fun. Winning is winning in every category. Winning by keeping your money. Winning by making sure your money goes to your family. Winning by know you're taken care of on your worst days. I mean, when you need help, the fact that there's money to take care of you is winning. It won't feel like winning when that day occurs in your family's life, but the family will look at it and go, he's taken care of. That's winning.
That's right.
That's what winning in retirement to be. Not always the positive. You get to go on more trips. We're saying, go have more fun. It's about bringing it all together. Right. And that all together is a big part of it is taxation.
Although sometimes I do have to tell people, yes, please take that trip. You've been dreaming about it, talking about it for a long time. Do it.
All right. So I'm totally off subject. But almost every talk show, financial show says, on their compliance, they say we don't offer tax advice. It's not tax advice. And the thing is that that's true because they're not licensed that way or they're not registered that way. They might not own a tax company like we do. They might not have the tax experts that we have here or have the history of taxes like we've done over the years.
Right.
And so the hardest part is how do you differentiate Akers Financial Group from all the other advisors? And the fact is we have a separate company, Daniel Allen Tax, that does the tax returns. They're in our offices. We go to them. They do our estimates. They help us work it through. When we have a situation, we bring in the enrolled agent and we say, what should we do? And they talk about it. I throw more ideas at it. Oh, yeah, that'll work, Brian. And we work it out. That's an incredible benefit for our clients to be able to take a full look at it on every piece. Big deal. It's a big deal.
Yeah, it is a big deal because we have to be careful. We've talked a lot about federal taxes, but we live in Maryland, so there's state taxes to deal with too.
We might be number 6 in taxes, but we're trying to be number 1.
We're working our way there.
And so what the hard part is that understanding what the taxes are now, and then there are some benefits in Maryland when you turn 65.
Okay.
There's a couple other benefits, but not a lot of benefits. Right. Unlike other states that are totally tax-free in retirement.
Right. Some are totally income tax-free for everyone. Some are tax-free in retirement, and some have larger pension exclusions.
Yeah. So like if you look at Pennsylvania, is a good example. You cannot pre-tax your retirement.
Right.
You pay tax while you're saving.
Right.
And then when you take money out in Pennsylvania, as a resident of Pennsylvania, it's tax-free.
Right. At the state level, it's all Roth.
Yeah, it's considered Roth. Yeah, so Pennsylvania sort of forced their people into the Roth, and that made them funds their budget right away, and then not to the future.
That's the state's problem.
Yeah, but you have to argue, are they missing out on something?
Right.
But the thing is that government can change their rules anytime, and when they change the rules, we got to look at what we're doing and understanding the cost and what's going on. The taxes in retirement does lead to decisions of some people on where to live in retirement.
Oh, yeah. There's a lot of folks that ask, where should I move to?
I tell them that should not be our number one decision, the taxes.
Right.
It's part of our decision. I believe that retirement and where you live is based on family and the life that you want to lead, not the taxes that you pay.
In reality, grandchildren are the number one decision maker.
That's probably I don't want to agree with you, Jeff, but I have to. But the reality is that if people move away, they come back for grandchildren. They also come back to be taken care of.
Right.
So they might retire or snowbird or whatever version of retirement they choose, and they go to a tax-free place, and then they come back.
Right.
They come back, and there's issues with that too. But understanding taxation in your retirement years and planning for it is what we're trying to get at. I believe that if you're moving to a tax-free state, then you look at the Roth and maybe you convert after you move.
That's absolutely right.
And then you can move back.
After the conversion's done.
So honestly, the way planning works is knowing your situation. We don't have your plan already written. We have to talk with you and your situation and figure out what's right in your exact setup.
That's right.
Whatever it may be.
Man, you got me stuck on that. Move to another state, convert, and then move back.
I know you're a Texas boy.
A tax-free state.
All right, so today's talk is pay less tax. Levelize is a concept where what we do is we pay tax in your current year by Roth conversion, by doing investments that are become tax-free later. This will allow you to control your taxes, pay less taxes over a lifetime. Mm-hmm. By paying tax now, you control your tax. And then you can understand when you retire that, yes, you pay tax, but you're controlling that by decisions that you make now. So what do? My answer is this. Go look at your retirement, how your savings, put money in a Roth. That'd be the number one thing to do. Right.
Make sure you qualify because there are income thresholds and everything, but putting money into a Roth IRA is a good idea.
And then add Roth at work. Then another thing is you have a free consultation with Akers Financial Group. Bring your tax return so we can look at where you are now.
Yeah.
And then we talk about the whole plan, and we project it out to the future and see, well, what can we do now to make things work better for you when you need it most in retirement? You want to keep that money.
That's right. You want it to be your money.
All right. Well, Jeff, this flew by.
Yes, it did.
Today's show was all about, it flew out, right? Today's show was all about pay less tax over a lifetime. Levelize your money and understanding by paying tax today. We do look forward to meeting with you. We want you to be winning in retirement by taking advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule a free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the schedule meeting section and let us know you'd like to schedule your free meeting right there. That's akersfinancialgroup.com, where you can go ahead and give us a call at 833-WIN-RETIRE, 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.